overall for us, the view on the U.S. China tensions has actually persisted over the past 3 years. I think then the headlines have always persisted. I think asset prices, however, can do different things depending on how expectations are priced. I think it is to some degree a familiar ground on the U.S. China tensions, given that we have had this in the past as well. I think then translating that to investments, I think that is actually where we're much more interested in terms of how it can perform and what kind of investments it can produce to generate more alpha for us as a bond investor.
And so where are you finding those opportunities?
So overall, I think the past few years, we have mentioned a fair number of times that the Chinese onshore bonds do represent a potential U.S.-China tension hedge of sorts. And on top of that, then there is a degree of yield that can be had within the onshore markets as well. So I think broadly speaking, I think it's good time to actually revisit during the summer some of these ideas as well. And I think then that means to us that we still maintain the view that under possible tensions escalating, then the China bonds onshore can actually perform still as a possible hedge. I think then towards the currency side, we've also maintained the same things. Hedging cost has been quite reasonable. None of that has actually changed. I think pertinent to what's happening globally, Chinese rates onshore actually do represent a degree of value compared to other parts of the developed markets as well.
Right. Give us your own sense, Jason, in terms of how you're looking at, the undervalued plays in the market, especially the sectors that have been hit by the virus quite significantly. So, the likes of airlines, travel, tourism. Do you think that there is a contrarian opportunity emerging here because the sell-off has been so brutal?
Sure. So I think we're not going to talk about specific company names within this backdrop, but I think broadly speaking, that the bottom line for us is always on a bottom-up assessment. Starting point then is, does each specific company have the means to repay or raise debt and service ongoing payments? So I think from that picture, the bottom line is you always have sectors which come under pressure. And also within that segment, you will always have stronger companies versus the weak. So I think broadly speaking, we tend to focus on the stronger side. I think on tourism, that's actually a very interesting one. I think in some degrees, from an optionality perspective, no one actually expects to be going on holidays to some countries very soon. But within Asia, at least, if you look, for example, in the case of Thailand, there has actually been over 28 days where there has been no local infections. So I think some of the things that the authorities there are discussing about is actually a consideration whether there should be travel bubbles within Asia that may include China and Japan. And I think then if these measures are introduced and successful without additional new infection cases, then I think that can represent a degree of upside, not only from different sectors like tourism or hotels, but also maybe from a currency perspective. We can see opportunities there as well if the tourism trades reemerge.